Hey everyone, Andrew here. Today we're diving into the 5 safest monthly dividend ETFs that could provide steady income and help secure your financial future. Here's what we'll cover. We'll break down each ETF, showing you why they're considered among the safest options for monthly income. I'll reveal which one has the best balance of safety and returns, and why that matters more than you might think. And finally, we'll calculate how much reliable income you could potentially generate with a $10,000 investment in each fund over 1, 3, and 5 years. Whether you're approaching retirement, building a safety net, or just want a stable income stream, these ETFs could be your ticket to financial peace of mind. So stick around, especially for number 4. It's a time-tested option that many income investors rely on. Let's get started with our first ETF, JPQ, JP Morgan Nasdaq Equity Premium Income ETF. This fund is like a backstage pass to the biggest names in tech, all while serving up a juicy monthly dividend. When we peek under the hood of JPQ, we're looking at a who's who of Silicon Valley. We're talking heavy hitters like Microsoft, Apple, Amazon, and Nvidia. These aren't just companies. They're the architects of our digital future. But here's the kicker. JPQ hasn't been around for decades. In fact, it just launched in May 2022. However, don't let its youth fool you. In its short lifespan, JPQ has been consistently paying out those monthly dividends. We're talking 15 consecutive months of payments, starting from the very first month it launched. That's a pretty impressive track record for a newcomer. And get this, those dividend payments haven't just been steady, they've been growing. In December 2022, JPQ paid out $0.3845 per share. Fast forward to December 2023, and that payout had grown to $0.5003 per share. That's a 30% increase in just 1 year. Now, at a buy price of $53.90, JPQ isn't the cheapest ETF on the block. But remember, you're not just buying a dividend machine here. You're getting exposure to some of the most innovative companies on the planet, plus the extra income from their option strategy. Yes, the fund uses a clever option strategy to squeeze extra income out of its holdings. It's like they figured out how to make tech stocks pay rent. For investors looking to tap into tech growth while still enjoying a steady stream of monthly income, JPQ offers a unique proposition. Currently, the fund is offering a mouth-watering 9.16% dividend yield. The next stock on our list is JP Morgan Equity Premium Income ETF. If JPQ is the flashy sports car of the ETF world, JPY is more like a luxury sedan. It's smooth, it's comfortable, and it's built to go the distance. JPY is offering a 7.19% dividend yield. Now, I know that's not as high as JPQ, but don't write it off just yet. Because JPY doesn't just rely on dividends from its holdings to generate income. It also sells options on the stocks it owns. I know options can sound scary if you're not familiar with them. But think of it this way. JPY is essentially renting out its stocks for extra cash, on top of the dividends they're already paying. This strategy allows JPY to generate income even when the market is flat or slightly down. It's like having a backup generator for your portfolio. When one source of income slows down, another one kicks in. But here's the kicker. Because of JPY's option strategy, this income stream tends to be more stable than pure dividend plays. In a world where market volatility is the new normal, that kind of stability can be worth its weight in gold. At the end of this video, we'll break down what having JPY in your portfolio means for your wallet. For now, let's move on to stock number 3, DGRW. At first glance, DGRW might not seem as exciting as our first two contenders. Its dividend yield is sitting at 1.55%, which might make you wonder why it's even on our list. But hang on, because DGRW has a few aces up its sleeve. First off, let's look at its price. At $81.69, it's the priciest of our bunch. But as the saying goes, you get what you pay for. DGRW is focused on quality dividend growth stocks. These aren't just companies that pay dividends. These are companies that have a history of increasing their dividends year after year. Think about that for a second. While the dividend yield might start lower, it has the potential to grow over time. It's like planting a tree. It might not give you much shade at first, but give it time and you'll have a forest. If you ask me about its performance, DGRW has been knocking it out of the park with an annual total return of 18.66%. That's not just good, that's great. It means that not only are you getting those growing dividends, but you're also seeing some serious capital appreciation. But wait, there's more. DGRW is sitting on a mountain of cash, $13.72 billion in net assets to be exact. That gives it some serious staying power and the ability to weather market storms. Next up, we have DIA. If the ETF world were a high school, DIA would be the popular kid that everyone knows. DIA tracks the Dow Jones Industrial Average, which is basically a who's who of American business. We're talking about companies like Amex, Salesforce, United Health Group, and Visa. These are the heavyweights, the companies that have stood the test of time. Now, I know what you're thinking. Andrew, the dividend yield on DIA is only 1.66%. Why should I care? Well, let me tell you why. First off, that 1.66% yield is rock solid. These are companies that have been paying dividends for decades. They're not going to suddenly decide to stop. In fact, many of them have a history of increasing their dividends year after year. But here's where it gets really interesting. DIA isn't just about dividends. It's about owning a piece of America's most successful companies. These are businesses that have proven they can adapt and thrive in any economic environment. Think about it. If you had invested $5,000 in DIA 20 years ago, you'd be sitting on over $20,000 today. That's a 300% return, not even counting the dividends you would have received along the way. Now, I'm not saying history will repeat itself exactly, but it does show the power of investing in quality companies over the long term. Last but certainly not least, we have Devo. Devo is offering a tasty 4.53% dividend yield. Like JEPI, Devo uses an option strategy to juice up its returns. But Devo takes a slightly different approach. Instead of selling options on all its holdings, Devo selectively writes covered call options on individual stocks. In plain English, essentially, Devo is betting that some of its stocks won't go up too much in the short term. If they're right, they pocket some extra cash. If they're wrong, they might miss out on some gains, but they still keep the cash from selling the option. This strategy allows Devo to generate extra income without taking on too much risk. It's like having a side hustle that doesn't require any extra work from you. But Devo isn't just about the options game. It also invests in high-quality, dividend-paying stocks. We're talking about companies like Goldman Sachs, Home Depot, Procter & Gamble, among many others. These are businesses with strong balance sheets and a history of rewarding shareholders. So with Devo, you're getting a triple threat: solid dividend-paying stocks, the potential for capital appreciation, and extra income from the option strategy. It's like having 3 income streams rolled into one ETF. Now, let's get to the part you've all been waiting for. Show me the money. I've put together a spreadsheet that shows what might happen if you invest $10,000 in each fund and reinvest all dividends. Let's break it down. I've put together a spreadsheet that shows what might happen if you invest $10,000 in each fund and reinvest all dividends. Let's break it down. Looking at our spreadsheet, JPQ's high yield really shines through. That 9.16% yield could potentially turn your $10,000 into over $15,500 in just 5 years. That's some serious growth. JEPI isn't far behind. Its 7.19% yield could grow your investment to more than $14,000 in the same time frame. Remember how we talked about its option strategy? Well, this is where we see it paying off. Now, you might notice DGRW and DIA showing more modest growth. Don't be fooled by their seemingly slow start. These funds are all about long-term stability and growth potential. They might not have the flashiest numbers now, but remember what we said about the tortoise and the hare? Devo, with its balanced approach we discussed earlier, sits nicely in the middle. Its 4.53% yield could turn your $10,000 into nearly $12,500 in 5 years. Not too shabby for a fund that aims to provide both income and growth. Now, let's sum it up and look at the power of dividend reinvestment over 5 years. If you invested $10,000 in each of these 5 ETFs and reinvested all dividends, your initial $50,000 investment could grow to about $63,857. That's a total gain of $13,857, or roughly 27.7% in just 5 years. And that's assuming no capital appreciation of the underlying stocks. Break it down, and you're looking at an average growth of about $2,771 per year. It's like your money is working a steady job and getting raises every year, all without you lifting a finger. But how about receiving $2,000 in monthly dividends? Watch my other video on a similar topic titled 5 Monthly Dividend Stocks for a Safe Financial Future, and I'll meet you there.